There's a thief inside your bank account. You can't see him, but he's stealing from you every single night while you sleep. That $10,000 you think is safe, it's being eaten alive. With inflation expected to be 2.4%, even the best savings accounts offering 4.09% are a lie. Your real return is a pathetic 1.69%. Your money isn't growing, it's fighting for its life and it's losing. This reality creates a trap. You know you need to invest, but the choices are an overwhelming wall of noise. Index funds, stocks, REITs. This analysis paralysis is the default for most people, and it leads to the worst possible outcome. You do nothing while your purchasing power melts like an ice cube on the pavement. What if the problem isn't the options, but the lack of a system? In the next few minutes, I'll show you the exact three-part allocation, 80%, 15%, and 5%, that you can set up in under an hour to build real wealth. This isn't about finding a magic stock, it's about implementing a proven framework for how to invest $10,000 without the guesswork. Because leaving it in cash is a guaranteed loss and picking stocks is a gamble. The system is the only thing that works, and it starts by understanding the single biggest mistake that costs new investors everything. Most investors think their biggest risk is picking the wrong stock. They hunt for the next Tesla, convinced that outsmarting the market is the only path to wealth. While those lottery ticket wins make headlines, for every winner, thousands lose, chasing a ghost. The data shows this entire focus is a dangerous distraction from the real enemy. The greatest risk to your $10,000 isn't a bad stock pick. It's the person staring back at you in the mirror. For the year ending December 2024, the S&P 500 index delivered a return of 25.02%. Yet, the average equity fund investor earned only 16.54%. That's a shortfall of 8.48 percentage points. Let's make that real. The market tried to hand you a profit of $2,502 on your $10,000, but the average investor, acting on gut feelings, walked away with only $1,654. That's $848 of your money. It was in your hands, and then it vanished. A 34% tax on your own fear, lost forever. Imagine two lines on a graph. One is the market, climbing steadily. The other is the average investor, a jagged, chaotic line that ends up tragically lower. That chasm between them is the behavioral gap. It's the feeling in your stomach when your portfolio is glowing red and the news is blasting "market in turmoil." It's the panic sell that locks in your losses. It's the FOMO that makes you buy a trend at its peak, moments after the smart money has already left the building. This single statistic changes the entire game. The goal is no longer to outsmart the market. It's to build a system that protects you from your own worst instincts. So, how do you go to war with your own brain? You don't. You build a fortress so your brain can't sabotage the mission. The system designed to solve this exact problem is called the Core and Satellite Framework. This framework isn't about picking winners. It's about building a fortress for your wealth that can withstand both market volatility and your own psychology. Let's lay the foundation, the 80% core. Step 1 is to allocate 80% of your capital, $8,000, to your core. This is the foundation of your fortress. The job of the core isn't to find a needle in a haystack. It's to buy the entire haystack. Its purpose is to capture the slow, steady, and historically reliable growth of the entire market with the lowest possible cost, removing your emotions from the equation. You do this with a single, low-cost, broad market index fund ETF. This is the foundation of how to invest $10,000 for the long term. For example, an ETF like VOO, the Vanguard S&P 500, gives you a small piece of the 500 largest companies in America. Or VTI, the Vanguard Total Stock Market ETF, which gives you a piece of virtually every publicly traded company in the US. The evidence for this is not just compelling, it's brutal. The Vanguard Total Stock Market ETF, VTI, has returned an average of 9.36% annually since it launched in 2001. Now stop and think about what that number has survived. That period includes the dot-com bomb vaporizing trillions. It includes the 2008 financial crisis, the greatest economic collapse of our lifetime. Imagine opening your account then and seeing half your money gone, your life savings gone. People sold in a panic, locking in devastating losses they would never recover from. Yet the investors who did nothing, who trusted the system of owning the entire market, not only got it all back, they captured all the growth that followed. That 9.36% number isn't a fairy tale, it's a battle-scarred average forged in financial fire. It's proof of the resilience of the whole, not the fragility of the parts. Let's make this tangible for your $8,000. Using a conservative 10% average return, the numbers become undeniable. In year 1, a 10% return is an extra $800. But in year 2, you earn 10% on that new total. That's $880. The growth itself starts growing. After 10 years, that initial $8,000 is over $20,000. In 20 years, it's more than $53,000. And in 30 years, without you adding another penny, it becomes over $139,000. This isn't a guess. It's the mathematical certainty of owning the market and letting compound growth do its relentless work. Conventional wisdom says diversify, but that word has been corrupted. Most people think it means buying 10 different tech stocks. That's not diversification, that's just a concentrated bet. True diversification is owning a tiny piece of everything: the boring, the exciting, the winners, and the losers. An ETF like VTI is a system designed to capture the market's overall growth. It's betting on the entire forest, not a single tree. You might be thinking, but this just gets me the average return. I want to do better. Remember the 8.48% behavioral gap. The data proves that simply achieving the average year after year puts you in the top tier of investors, far ahead of the majority who are trying to be clever. The core is your defense against that gap. It automates the single best decision so you don't have to make any others. With 80% of your capital secured in that fortress, the long game is already won. But that still leaves the part of brain that wants a shot at something more, and that's where the last 20% comes in. Step 2 is to allocate 15% or $1,500 to your satellites. This is your designated area for taking calculated risks. This is where you can satisfy the urge to pick winners without jeopardizing your core wealth. Instead of picking individual stocks, a smarter approach is to make a concentrated bet on a sector you believe has long-term growth potential, using a sector-specific ETF. This could be technology, healthcare, or clean energy. The choice depends on your own research and conviction. A hypothetical case study from Arta Finance shows how this structure works in a larger portfolio. Their satellite sleeve included allocations to specific areas like technology stocks and defensive investments like healthcare ETFs. The principle is the same. The satellite is for targeted bets. For you, this means if you have strong belief in the future of AI, you could allocate your $1,500 to a technology-focused ETF. But isn't this risky? Yes, concentration is always riskier than diversification, but the risk is mathematically contained. Because it's only 15% of your total capital, even if this satellite gets wiped out, it can't sink the ship. Your financial future is already secured by the 80% core. The satellite is simply an opportunity for outperformance, not a requirement for success. Step 3 is the final 5% or $500. This is your safety net. This money does not go into the market, it goes into the most liquid, accessible place possible, a high-yield savings account. The best of these accounts are offering annual yields up to 4.09%. This isn't an investment, it's a tool. It provides liquidity for unexpected opportunities or emergencies, preventing you from ever being forced to sell your core investments at the wrong time. This is the complete 80-15-5 framework. 80% in a broad market index fund for steady, long-term growth. 15% in a satellite ETF for a concentrated, higher growth bet. And 5% in cash for safety and flexibility. You now have the complete blueprint. But a blueprint is useless until you break ground. So this next part is the most important, the exact checklist to put this system to work. Here's a simple challenge for tonight. Don't sign up for anything, just open a new tab and look at the home page for Vanguard or Fidelity. That's it. Comment done below when you've taken that first tiny step. Step 1 is to open a low-cost brokerage account. You might think this is complicated, that you need an advisor. You don't. Firms like Fidelity or Vanguard are built for you to do it yourself. The process is entirely digital and takes about 10 to 15 minutes, less time than ordering a pizza. You'll need your social security number, address, and employment information. Just follow the on-screen prompts and select an individual brokerage account. Step 2 is to fund the account. Connect your bank account and initiate a transfer for your $10,000. It can take 3 to 7 business days for these funds to fully settle. This waiting period is normal. Use the time to finalize your fund choices. Putting it all together is step 3, executing the 80-15-5 allocation. Let's do the specific math. Your core is 80%. 10,000 times 0.80 is $8,000. Your satellite is 15%. 10,000 times 0.15 is $1,500. And your safety net is 5%. 10,000 times 0.05 is $500. Once your funds have settled, you'll place 3 simple orders. For your core, you'll search for the ticker symbol of your broad market fund like VOO or VTI and place a buy order for $8,000. For your satellite, you'll find your researched sector ETF and place a buy order for $1,500. Finally, that remaining $500 can stay in your brokerage's money market settlement fund or be moved to a dedicated high-yield savings account. Your fourth step is a small setting that changes everything. Turn on automatic dividend reinvestment. Somewhere in your account settings, you'll find a button for this. Clicking it ensures that any dividends your ETFs pay out are automatically used to buy more shares of that same ETF. It's like a tiny automated farming operation happening inside your account, creating a powerful self-fueling compounding effect. Your only job was to flip a single switch, and it works for you for decades. With that system in place, your final job is to avoid the traps. To help you stick to the plan, you can use a tool called an investment policy statement. It's a simple one-page document you write to yourself to define your rules before you invest, so you don't make emotional decisions when pressure mounts. The link for a template is in the description. With your rules defined, you can focus on avoiding the 3 biggest pitfalls. First, when the market drops, and it will, your instinct will be to sell everything to stop the bleeding. Don't do it. Panic selling only locks in your losses. Your 80% fortress was built for these storms. Trust the system, not the momentary fear. Second, ignore fees. Low-cost funds are essential because fees compound just like returns, but in the wrong direction. And third, never compromise your core. That 80% fortress is your protection. Don't ever gamble with it. That $10,000 that was being stolen from you every night in your bank account, it's now the foundation of an engine designed for long-term growth. Your only job tonight is to open a new tab and look at Fidelity or Vanguard. Just look. That's the first step. Because this isn't just a plan for how to invest your first $10,000. It's the blueprint that turns 10,000 into 100,000 and beyond.